And we are back. It's a Monday. And you know what we do on Mondays? We discuss investment strategy in terms of how you're going to trade and place your positions for the week. Helping us with that conversation is Mr. Martin Kirimi. He's a senior associate of the research team at Standard Investment Bank. Welcome, Martin.
Thank you for having me.
You're welcome. I think before we just delve into your report, you have an extensive report. We were discussing earlier on what's happening in as far as the T-bill yields are concerned. Today, the 364 days at 8.75%. A week before, it was at 9.05%. What are your thoughts on that?
It's pretty interesting because at the end of the day, we sort of foresaw that happening because after the rate cap, all the banks channeled their excess liquidity to the government paper. Now with, I have to give credit to Njoroge and his team and the Treasury Department at large by making sure that they're pushing the yield curve lower. So to add to that, I'll actually put a spanner in the works. I'll say that I hope the rate cap is not repealed.
Wow.
Yes.
Why?
Simply because at the end of the day, if you're pushing the yield...
Finally get someone who's aligned.
Who's aligned to you.
Exactly. Okay. Because at the end of the day, if the yield curve is being pushed lower, banks will have no other option but to lend.
Wow.
They have no option. They have to get returns. And where you're going to get a better return right now is to lend to the Wanjiko. We're together on that?
Yeah, we are together on that. But just want to ask you, Martin, just a side note. I mean, the T6 years T-bill is at it's just fallen below 9% in a long time. Where are money markets funds getting 14% from? What kind of allocation is that?
I saw your article last week. I think it's aggressive, like you put it, aggressive asset allocation.
Yeah.
So I think most of the funds that have checked that are giving north of 10%, even 12% return, you find that if you investigate their asset allocation, it's usually tilted to illiquid assets.
Yes.
Yeah.
So you'll find a fund manager taking your short-term paper and taking them and investing in illiquid assets, that is in your real estate segment and all that.
And commercial paper.
And commercial paper. Commercial paper right now is pretty, I don't think even right now there's that much market in the commercial paper space.
There's absolutely nothing happening
Precisely.
there.
After your Nakumat went ahead and Nakumat, Kaluwax, which is the other one I remember.
ARM cement.
ARM actually.
ARM especially. ARM cement was the worst.
Exactly. So we can go ahead and discount that fact that they're actually putting, distributing the monies in pretty illiquid and risky assets.
Which is not the whole purpose of money market funds.
You really do not. What you want to be focusing on return, but you need to be
preservation of capital.
Exactly.
Preservation of capital. You have to preserve capital. So that is a key concern, if I can put it that way.
Okay.
Yes.
Wow. And let's talk to sports now.
Okay.
Foreign participation, we saw an increased inflows of foreign net portfolio position in the market, especially in the month of May. Obviously, one of the biggest beneficiaries, Safaricom. But there was on a month-on-month basis, there was a significant outflow, net outflow position in the month of June. Or rather, Q2 was still net positive, but there was a big outflow in the month of June. Do you still attribute this to, I mean, you've said this before, do you still attribute this to the reworkings of the MSI index and the inclusion of Kuwait in the index?
Kuwait into now emerging markets.
Yes.
I'll start first of all with May. May, towards the tail end of May, as you can, from our report, shows that foreign inflows, we're talking about foreign inflows of $21.5 million.
Yeah.
That's net position.
Yeah.
The key contributor to that was Safaricom. Towards the tail end, when now we noticed the portfolio, foreign investors doing a lot of portfolio realignment after Kuwait now was upgraded into emerging markets, but it will take effect next year. June took a hit because we noticed most of the hit was due to bank stocks. Foreigners, a lot of outflows in the month of June were tailored towards banks. And the key thing about that is we attribute that to the fact that the last time when I was here, we talked that we are bearish on banks.
Yeah.
The key.
I'm still bearish on banks.
You're not alone.
Yeah.
So
I'm the only one who's bullish on banks.
I'm bearish on banks as well. Tell us why.
Bullish on banks, I will.
Okay. Because now the multiples might look attractive, but
Yeah.
now the question is what will drive multiples going forward? We're already seeing now the yield curve is being pushed lower, okay? That is interest income going to be compressed. So which banks will go ahead and think outside the box, okay? Because now you have to increase your margins. You have to increase your top line. Your top line will either increase by right now. It's no longer margin driven, it's volume driven.
Yeah.
Are you going to lend more to go ahead and increase your volumes, your annuities from loans,
Okay.
vis-a-vis now previously where now they're always channeling through the government papers.
Yeah.
Yes.
So the key concern here is who will design the best growth story?
Precisely.
Okay.
Digital, we talked about digital. We talked about digital. But now, when you look at the digital part, the figures you mentioned, one of the things that we need to take note of is that most of those figures are usually overlapped. By this I mean what? If a client goes and pays through EasyPay, if I have an Easy Equity Bank client, or let's say I'm a M-Pesa client, I go and see the merchant has an EasyPay pay bill.
Yeah.
I'll use my M-Pesa pay.
Exactly.
To
So
the EasyPay.
it's becoming okay.
Precisely. So on M-Pesa side, they'll record that part as a transaction. Let's say 10,000. But still on equity side, they'll still record that 10,000 on their side. So when they're reporting those figures to your CAK, the Communications Authority for that matter, there'll be an overlap.
Is that a double counting?
Absolutely.
This
There's
is
an
a big
overlap.
economic crime, double counting.
It's not.
But Martin, look, among the frontier markets in Africa, Nairobi Securities All-Share Index was the worst performing. I mean, Zambia was the worst. Lusaka's All-Share Index was minus 25%, 24.8%.
Yeah.
But obviously, I'm not going to talk about Zambia because Zambia is a unique case. It's an outlier for the principal reason that they're about to default on there. They were downgraded to junk, triple C. I'm going to strip them out. Then talk about Egypt, Ghana, and Nigeria with the worst performing.
No. But look at from year-to-date perspective.
Yeah, YTD we are good, but remember, we are also narrowing in. Was there something unique that happened in Q2 then?
The most unique will be book closures, especially for banks, the month of May.
Okay.
That's why you actually notice the market was down 4.3 the month of May.
Yeah.
June was just 1.6%.
Yeah.
We can say that is portfolio realignment.
Actually, and Martin, when you're talking about the outflows, sorry to cut you short, did you notice this outflows closer to the end of June, or were they just going through May and April and June? Because I'm trying to understand whether there was any impact based on the budget reading and the CS alluding to the element of a rate cap. No impact?
After the budget reading, it was pretty indifferent.
Indifferent. Okay. Thank you for that.
May that's when
that's when the
outflows were, and we noticed a lot of sell-off, especially for bank stocks.
Okay.
Yeah, that's due to book closure. We'll say that due to book closure. Yes.
But also just coming back to the element of looking at the Nairobi Stock Exchange, Securities Exchange compared to other African markets, I notice here in your report that it's actually been receiving better inflows with regards to foreigners compared to Nigeria. And anytime you're looking at sub-Saharan Africa, you're always pitting the Nairobi Securities Exchange vis-a-vis the Nigerian Stock Exchange. What is happening there? Are we seeing more interest on the Kenyan side?
This is a good question. When I pulled a report on the MSCI index frontier markets for Nairobi for the month of April, as at end of April. And you could see of all the MSCI index in the frontier markets, Kenya was the top.
Wow.
Okay. Over the last couple of years, been the top most performing. Even if we were down 18% last year, we're actually better than all your your Nigerias, your Zambias and the like, and your Ghanas and the like. So we'll say that is more of foreigners taking interest in our market. And the four key counters are what they focus on. That is your Safaricom, EABL, KCB, and Equity.
And Equity,
Those are the key counters.
Those are the key counters. Because actually in your report here, the last reported number in May, there was foreign flows into Nairobi net were $21.4 million, whereas in Nigeria it was minus $5 million. So I think you're saying the element of MSCI and the foreign investors benchmarking their assets, or rather their asset allocation strategy based on that?
Based on performance.
Okay, interesting.
Yeah. Martin, I must say that your SIB Q2 report was quite comprehensive. I mean, people should, I hope your clients will be happy with this. Very informative. But I just want to bring you to top gainers for Q2. And you look at top gainers, Martin, actually the entire list of top gainers, top 10 gainers. Small fringe stocks, you know.
Yes.
Do you think that asset managers need to look at the fringe stocks, that they should have a trading strategy around the trading strategy around the small cap stocks, because they tend to deliver alpha? Look at this one. Samia Africa's app Q2 delivered 67.8% in Q2. That's, and look at Transcentury 35.5.
Look at
Longhorn 23%, Kakuzi to 13.7%. In terms of, can this form part of the asset manager's trading strategy? How do they factor in? Well, we spoke to an asset manager here, and they're saying that for them the problem is the illiquidity discount. But how do you reconcile the liquidity discount and the fact that these stocks are delivering alpha? Look at Samia Africa.
The question, I like what the fund manager said. It's all about liquidity. When you look at some of these stocks, if we check the volumes, I'm pretty sure you'll see the volumes. You're talking about volumes of around 100 shares, 200 shares per day.
Yeah.
Even per week, actually.
Yeah, right.
So we can't read too much into the stock, into how the performance of the small cap and small caps vis-a-vis the large caps.
Yeah.
Liquidity component is a very key factor.
Yeah.
I'll give you an example. Longhorn. North of 75% is owned by Centum. That shows you how much.
Absolutely no liquidity.
There's no liquidity of that stock.
Yeah.
Actually, for them, it just works for their Centum's books, because then their net asset value improves.
Precisely. Absolutely. So at the end of the day, we had this conversation even the last time. Liquidity is a key component right now. Not only do we need to see stocks being listed, we need to see liquid stocks
being trading. But Matt, how do we get liquidity? Because for instance, look at stocks like Nation Media Group, which to me is a very big conglomerate, needs to be very super liquid. You can easily get a block of 1 million shares, but as it is, you can't get even a block of 1,000 shares on Nation Media Group. How does the exchange enforce liquidity standards? Do you think it's within the purview of the exchange to enforce liquidity standards? I think they need to come up with minimum liquidity standards.
I think so too, to increase also the market participation at the end of the day.
Yeah. You think some stocks will split, like for instance Standard Chartered?
Should do a stock split.
Yeah.
The parent allow that, because the parent is the person.
No,
it's all about this stocks
market
they're in the market, yes.
Market enforcement.
It doesn't matter who's owning Class A shares.
No, but you can't have a capitalistic environment and then your regulator determines what companies do.
Well, the thing is that maybe that we need to have minimum, let me not even liquidity, minimum free float standard. Like a company should ensure that at least 20% of its ordinary shares, outstanding ordinary shares, the fully issued and paid, should actually be considered free float. Those can easily exchange hands. Well, you have some countries where it's almost negligible. Yeah, you have people who never traded. So my question is, do you think there needs to be minimum liquidity standards, or that's I'm going over the roof?
You're becoming too. What's the word? You're too over regulation, if that is the word.
Well, it's not a regulation, but this could be like trading floor rules.
Why?
Yeah, floor rules. Not really regulation.
Come to think about it, I like his idea.
Trade floor. So like have
minimum.
But it actually, I think it's actually there, because there is a cap on foreign ownership,
well,
which in a way is assumed.
They removed it.
They removed it, right? So that's already been removed.
Yes.
But I'm looking at it and saying it's a market where you either buy and sell shares.
Yeah.
Really, if you want a share, you should be able to go and demand for it.
No.
I don't think you need the regulation to say we need a minimum of 5% allocated to a certain class of investors.
Well, look, it is, if you're holding 1 million Kakuzi shares today, would you struggle to dispose them? I mean, it's difficult. Because you just struggle to find someone who wants a block of 1 million shares of Kakuzi shares.
Absolutely,
yes.
There's no doubt.
So that that in my view, that constraint, that liquidity constraint, for me, is another constraint to price discovery.
Interesting. Hold on to that thought. Let's take a quick break and look out for the opening bell. And we are back discussing June 2019 and second quarter 19 performance on the NSE. Martin, when we're looking at the market capitalization, the top 20 stocks, it looks like it was a bad birth for all the banks, except for Safaricom. Safaricom was 2% up. Everything from EABL all the way to all the listed banks were all down. The other exception was Kengen and Umeme that were up. Kengen up 5.3%, Umeme up 3.2%. Tell us, what's going on here?
Safaricom, one of the key things to note is that right now Safaricom accounts for 49.2% of the market.
Wow.
It's just half of the market.
Which is basically half of the market. If, were it not by God's grace like that, the market was, Safaricom was up just 2%, it would have been a bloodbath for the NSE. Absolutely.
Essentially, if Safaricom catches cold,
the whole market gets a cold. No, catches a sneeze.
Yeah,
Gets a sneeze, basically. So, like I actually pointed out earlier, the bank stocks were the main, all the bank stocks took a hit in the second quarter, and that coincides with book closure. Book closure usually happens in May, so everybody, once you've gone ahead, you've gotten in your div towards the tail end of June, July. Most of the investors actually just, it's trading ex-dividends.
But that's interesting because then the correction could actually not necessarily be foreigners exiting, but more of a correction of price. So if I have a dividend of 1 shilling, then the price corrects by that.
Absolutely, it's ex-dividend.
It's ex-dividend. So it's actually more of ex-dividend and book closures that impacted.
Absolutely, because when you notice year to date, still the bank stocks, most of the bank stocks are still up. Aside from COP Bank. COP Bank is the one that is down year to date 16.1%.
Oh, that's a huge...
That's a huge hit. Aside from that, all the other bank stocks are actually on the positive. I&M is still up 29.4% after they did a bonus issue, one-to-one bonus issue. They're still on the positive when you discount the bonus issue. COP, I'll go ahead and attribute to the fact that it's a bit, probably I'll land in trouble with management. For this.
Come on, you're on Metropole, Martin. You don't have DCI schools waiting for you outside.
I find COP a bit, for lack of a better word, lazy.
Yeah.
That's my view.
Yeah.
They're not, I don't find anything exciting coming from them. It's your same old vanilla feel.
Yeah.
I don't hear innovation in that space. I don't hear collaborations in that space. I don't hear acquisitions. I don't hear new markets.
That's interesting.
There's nothing to excite the market, in my view, about COP Bank.
Yeah. And you know, interestingly on that, they were part of the MSCI, and then they had to be removed because when they joined the MSCI, then they got foreign investor visibility, but for some reason internally they were unable to restructure the organizational structure, because for you to be on the MSCI, the thing that George is talking about, you must have liquidity. It's owned by the SACCOs. The SACCOs refused to relinquish, 68%. And for them they were more open to actually getting out of the MSCI. Then it was easier to get out of the MSCI than to actually reorganize its investment ownership and produce or supply liquidity.
That's the epitome of laziness.
That's the thing. Every time I cover COP Bank, I never feel there's nothing exciting. I'm sorry.
You struggle to figure out a growth story.
Absolutely. Yeah. I can't see the growth story. I can't see what next, what new innovation. They'll say they still have your digital lending and all that. But they're
latecomers.
They're latecomers. Absolutely latecomers. And when I look at one of my biggest problem with them is that they have a branch network of north of 130, if I'm not wrong. It should be 130 and there. But look at their cost of funding. It's way up there. Like that shows you your retail side. It's no longer
the branch utilization in terms of liability mobilization is not very there. I agree on that.
Absolutely, yes. You can't compare that with your Equity Bank or KCB for that matter.
Okay.
Yes.
So epitome of laziness explains why the market has punished it minus 16% year to date. Worst banking stock.
Worst banking stock.
But let me, Martin, just take you back a bit. How important is book closure as a trading strategy for any investor? Because you've cited book closure a lot.
Book closure, absolutely.
It's a very important, it's a material aspect of trading strategy, right?
Yeah, absolutely. Because I think investors I'll give you an example of bank stocks.
Yeah.
If I look at your Q3, by the time first half numbers are out, I could comfortably project if the second half is going to be good or bad.
Yeah.
And will the DPS, will the payout increase or not?
Yeah.
If it increases or not, you notice that early in the year, bank stocks were actually ticking up because now investors start taking positions.
So in first quarter, in fact, they're all positive in the first quarter.
Precisely,
okay.
yes.
Okay.
So you start taking positions. I'll start basically take my positions in early quarter, your January, Feb, or even towards tail end of December. By the time book closure ticks on, I have a pretty good div yield.
Okay.
I'll be talking
You have
about
a good view of the dividend yield.
Precisely.
Yeah.
If let's say I got in, give you an example, if I got in at, let's say Barclays, for instance, that usually have a very good dividend yield of north of 9%.
Okay.
If I entered at beginning of the year, when it was just around 10 shillings thereabout.
Okay.
They paid a dividend yield this year of a DPS of 1 shilling and 10 cents. That
Okay.
gives me a dividend yield of close to 11%, 12%.
Yeah.
So see, I mean the money.
Then you hold it. So in other words, you're saying you want to be able to buy the banks in third quarter because you have a sense of visibility. Hold it through to first quarter when they announce their dividend, and the dividend, and then thereafter in second quarter begin to exit.
And exit. Just
Wow.
before
Absolutely.
the book closure.
Fantastic.
That's
Just
a perfect bank strategy
Perfect
closure.
bank strategy.
Precisely, yes.
Well, you don't think rate cap is going to be a material news for the bank portfolio?
Rate cap has been with us for now close to 3 years.
It's almost becoming boring talking about rate cap,
Absolutely,
right?
absolutely. So right now the key thing now should be what is the next, how will banks go ahead and reinvent themselves?
Okay.
Because this talk every other time, when I remember there's an investor briefing with George for Barclays, and he actually had to go ahead and ask the CFO, when are you guys going to stop talking about rate caps?
Yeah, because
every other time is going
It's
to be
rate
rate
it's so
caps.
boring when
Rate
management
caps.
keeps saying,
Exactly.
citing rate caps, oh, it's rate cap, it's rate cap. I mean, they need to move on, right?
They need to
This
move on.
nostalgia about rate caps.
Precisely.
We actually need to see, because private sector growth, I think the last number was slightly below 3% year on year.
And SIB has it here.
And we have it
They
here.
have, they have it here. I think the private sector credit growth.
Okay, brilliant.
They have
That's
it
a great
here.
number.
It seems to be, there's a slight uptick.
There's a slight uptick,
on
so it's
the-
becoming positive.
Yeah. Yeah, it's
Oh, yes,
becoming
here it
a
is.
slight up. It's still under 5%.
Okay.
It's still under 5%.
So there's been some positive performance from February.
Yeah.
Actually, yeah, it seems to be going over the trend over the last 1 year.
Yeah.
So maybe banks now are going to be pushed into lending.
But well, I think 5% is still very small. Coming from where we're coming, about
12,
15. We actually at some
Actually,
point
even go extend 5 years, 25, 30%. We were at 5 times the multiple
Well, 5
of GDP.
is very small.
Yes.
But there seems to be, because of the base, we're coming from a very small base of 2% or just close to 0 to 5%. That's something significant. What have you noticed is driving loan book growth in some of the banks that you've looked at?
Personal lending,
Yeah.
no doubt.
Yeah.
Because right now with digital, the beauty about digital, it's so cyclical.
Yeah.
If I can put it that way. And your bank will go ahead and earn both from fee income and your interest income.
Yeah.
Secondly, they're very shy. What is driving growth? Also, they're very keen on manufacturing, but not all aspects of manufacturing. They're very, like I talked
They're
to,
cherry picking.
Okay.
they're cherry picking, absolutely cherry picking. Real estate, it's a no-go zone for them.
Okay.
Right
Yeah.
now, it's, unless you're doing your Eastlands,
Affordable housing.
affordable housing.
Dandora.
It's your Eastlands,
Okay.
yeah, your Eastland side. Up market
No.
is a no-go zone.
Yeah, the rental yields are almost not there.
Absolutely. Just
Yeah.
look at actually what is driving the NPLs
Okay.
basically. Real estate is one of the key segment, and trade. Also trade, it's more of still cherry picking. Which lenders, which borrowers are we going to?
Not everyone will.
Not everyone. Not everyone will basically getting
the ones you're comfortable with.
Absolutely.
Okay.
Yes.
So then where do you see this number going to by the end of the year? Because it has been on a positive trajectory from December, and we're now at about 5%. So then do we see ourselves ending up at 10% in another 6 or so months?
If the government, if the yields, if the trajectory of the government yields keeps gaining momentum, that is downward, there'll be no other position to go ahead and allocate capital for banks aside from lending.
Okay.
Yeah.
Okay, so that's why I'm all the view of we actually don't need that rate cap removal. It's actually a good thing.
Yeah.
Okay, in my view,
It is,
now,
I agree with you.
right now it's actually a good move because the moment if the yield cap start going up, now that's where the problem now will be like, okay, this one will flatten or now possibly go down. But looking at the macros going forward, I'm looking at the interest rate environment on the global space. Gonna be lower next year.
Okay.
Yeah.
So actually, if I was government right now, I'll tilt more of my lending towards foreign. I'll tilt it actually towards foreign because the yields
Are coming down
as well. Okay, and then shy off a bit on the domestic market.
Yeah.
So banks will have no option whatsoever but to lend.
Come and lend to
But
your border.
let me
They'll
just
actually,
let me come back to
not your caliber, basically not
Anybody.
people of your caliber.
so Martin, you're saying that private sector growth could improve, assuming that rate caps remain where they are, and we've also said that the trading strategy for banks is more or less done. So this could potentially be the worst performance that we see.
Yes.
So based on this performance on year to date and second quarter, where do you see upside in the banking sector? And who is actually going to get any growth if the private sector lending grows?
Your mass market. No, currently, if you notice, if the banks that were tilted towards corporate lending are still better off at the moment vis-a-vis your mass market, the mass market banks previously, because those are the banks that took a hit.
All right.
Because your mass market banks were basically able to book big margins, get your 2-3% cost of funding, lend at 15, 17, 18%.
Okay.
Your corporate lending banks, that is your Standard Chartered, your Stanbic and the like, they're still able to maneuver. The NIMs are not hard hit as the other banks.
Wow.
So going forward, who's going to still benefit more? It's the lender that goes ahead and, number one, improves the efficiency levels, that is cost to income ratio, improves the margin, the volumes basically.
Okay.
If volume driven, if you're no longer now lending you're no longer lending for margins, but basically lending to get bigger volumes.
All right.
Yes.
Just you talk about volumizing business for banks.
Yes.
You think how big of an impact, how big of a utilization should big data be on this one, big data analytics? Because I mean, my argument has always been, now banks need to know their customers, right? I mean, previously your bank was okay making 20% margin on you, and they don't really care about your other, financial stuff is all about utilization. It's where am I getting my insurance from? Who's giving my credit card? My education policy, my general insurance, my car cover. It's a question of, today, the bank looks at you and understands your financial touch points. And then they want to seek to domicile these. They need to understand now, they need to understand whose credit card you have, who's giving you life insurance, who's giving you car insurance cover, where do you shop mostly?
Wow.
So they can
Big
give you
data.
offers.
Yeah.
So
It's all about
big data impact on whether
it's
okay.
now the bank needs to understand your financial touch points.
Wow.
So that they can, it's all efforts of creating volumes.
Okay.
Yeah.
Very interesting conversation there, and I'd like him to answer, but then as always, our time is always limited. So I need us to maybe just wrap our heads around what has happened, what do we expect to happen, and also maybe just touch on Safaricom as we come to the near end of our show.
So Safaricom, pretty sad news indeed today. We lost the CEO. Mr. George actually alluded earlier on that we don't see a vacuum, even us we don't see a vacuum, because last year in 2017 Bob took 7-month leave, if I'm not wrong, sick leave. During that time, investors were not jittery at all because there was no leadership vacuum. The board came forward and was able to set up a team, basically Mr. Satish and the gentleman, to make sure that the smooth running of the organization, which will be a bit interesting to see how the market interprets that today. But I don't think that there will be any jitters in terms of any leadership vacuum in Safaricom. We don't see that happening.
And then what do we then need to look out for in terms of third quarter 2019? Where do investors need to place their money to be able to make a return?
We should, first of all, the question will be now on, I'll still focus on banks because that's what I cover mostly. We need now to see what's the talk from management now that the government yields are actually going low. Are they pushing now? Are they pushing now more towards volumes?
So we need to just see what the drivers are and see if there's upside in banks. Absolutely. And I guess maybe the key dates to look out for is the finance bill.
Exactly. The finance bill. We want to see actually
that's a very interesting
go along.
All right. Thank you so much, Martin, for your insights. I don't know if you have any parting shots.
I think for me, the parting shot here today, I mean, being a very sad day, woke up to the largest company in the market losing CEO. I think for me, it's the key thing for investors is that the key man risk as Safaricom is very low. And that they should take heart in that, but otherwise I think I'd just say rest in peace for the CEO.
It's sad indeed.
Very sad. So, ladies and gentlemen, there you have it. A very sad Monday morning for us here, as we have lost Mr. Bob Collymore, the CEO of Safaricom. We don't see any key man risk there, but it's certainly a sad day for the country, for the investors in the local stock exchange, and for everybody affiliated to him. Our deepest condolences and comfort to his family. We have been talking second quarter NSE. What has been happening there? Safaricom was the best performer. The banks were the worst performers, largely on book closure. If you're looking for a trading strategy, then you need to be looking out in third quarter again for the banks and for the key date on when the finance bill will be read. Keep it here. We'll be back in the afternoon at 2:30. But for now, we leave you the market highlights. Good morning.